Hello and welcome to the paid weekly recap for the week ending July 3rd, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the predictive AI for dynamic markets trading system. Before we get started, normal disclosures. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trade advice. And please also keep in mind that myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. If you need more time with disclosures, please go ahead and pause the video now. Otherwise, we'll get into the recap for the past abbreviated week. First things first, we had the 10-year yield, a broadly rallying 10-year yield. Overall, we had this shift higher. A lot of this seemed to be in reaction to some of the big, beautiful bill progression through the government, as well as some modifications going on through there. We're staying within that range. 4.2 to 4.5, 4.6 seems to be the range right now. 4.4 generally right in the midpoint. As we tested the low end, we bounced back. There's broadly not much shift here, and seems to be a lot of confidence in the general plan for what the Fed's going to do for the rest of the year. It seems like we're looking at two cuts. It's just a question of when. We've got the July meeting, we've got the September meeting, which one's the first. December, by then we're expecting to have a second cut. So we may have one in July, and that could open the door for as many as 3 cuts this year. But it seems like, generally speaking, we're looking for the 2 cuts. If it's skipped in July, it seems like that's almost in stone, barring a big fundamental shift in the broad economic conditions. Along with that, the S&P 500 continues to move higher. Tuesday was a little bit of a sideways day, but then we had the continuation on Wednesday, breakout on Thursday after non-farm payrolls came in well. Closed near the all-time highs, just off the highs of the session. All in all, everything bullish here. The biggest potential yellow flag, not a red flag, is the fact that the RSI is up to 74. For the broad market, seeing the RSI up elevated such as this is not usually a long-lived environment. It may happen for a few more days. We may get a dip prior to the next move higher. And actually, if you look at the futures markets on Friday, we did have a little bit of a pullback on the Friday market, and we'll see if that continues through into the open on Monday. But broadly speaking, bull market, dip buyers, as long as we stay above the February 19th highs, people are going to stay very confident, and we're getting more and more distance above that level. So as we continue to press higher and higher, the bull gains more and more confidence outside of profit taking and maybe a new fundamental input shifting and driving a dip or a pullback. We do have earnings coming up in a couple of weeks, starting with the financials, not this week, but next. And that may have an impact on the market behavior. But overall, this is a bull market. Tech also continuing firm. Now we had some rotation. Tuesday, we had the pullback in tech. Well, small caps, which I'll come back to, went higher. So tech was getting a little bit of profit taking here, still going higher, still participating in the bull case, but not necessarily as much as those value hunters in the small caps. We have the RSI at 72 here, not quite as high as the S&P. We have seen the RSI above 70 in the last few months, a few times in tech. So naturally, it's natural to see some profit taking there. All in all, it's a bull market still. There's nothing for me to be particularly concerned about as, again, we stay above those February 19th highs. And tech is naturally going to have some profit taking and rotation that gets us into that small cap scenario that I mentioned, where small caps got above the 200-day moving average and started to push. Now, small caps are not at the all-time high. That was made back in February, early February for small caps. We are getting closer and closer, but have not gotten there yet. Financials, healthcare, maybe energy names, that can help drive this market higher. And we're seeing some money flow into financials and healthcare, but not quite enough yet to push to a new high. So if that occurs, if that rotation continues, then small caps can join that bullish party with new all-time highs, but we're not there yet. Again, 72 RSI, a bit of a yellow flag here for potential for a dip or consolidation prior to the resumption of the upward trend. Now, finally, we got the VIX, maybe too high now. So 16 and a quarter, 16.4, 16.38, I guess technically, seems a bit elevated given current market conditions. We haven't seen a lot of buy rates out there yet. So most of the behavior seemed to be about buying puts initially, and then as we broke out, rolling those puts higher by buying put debit spreads. So buying a slightly out of the money put to protect and hedge against a dip, not a collapse. And now the market is buying put spreads to roll up the protection and define the risk to the downside, buying more relevant insurance, and getting rid of the insurance that would be more of the lifeline insurance at this point. It seems natural to do so when we're overbought and we may have a dip. But the question becomes, when does the bull exit the hedge if they're not exiting the position? So the benefit of a hedge is to be able to buy a dip or to be protected in case of a dip. If it's all just to be held, to be a protection against the dip, but not sell anything, including the hedge, that's fine. But we'll see the market dynamic as we continue to shift here. And if we start to consolidate, I do expect to start seeing some buy rights, people selling further out of the money calls against their long positions as a way to finance some of the hedging that they've been doing. If the VIX drops back down towards 13, that would seem to be a good target for me at this point. However, 16 still allows for a lot of leverage in these paid ideas, and we're going into earnings season, so it is natural to have a little bit of elevated volatility for earnings and some of the other fundamental inputs out there. I think part of the reason we're still at 16 is frankly still a memory of the early April chaos. Even though that was at the lows, and we're now back at all-time highs, there's still a memory of what it felt like not to be hedged during the break and how much people were having to pay in premium to get hedges at the lows. So there is a natural demand from that perspective, understanding that recent memory may shift a little bit of the trading behavior. But at the end of the day, until we see some more buy rights, the ceiling of the market is a little bit less capped. And as we see that come in, that can actually help cap the market, slow down the move, bring down the RSI, and continue to get us into a more traditional bull grind mode. Speaking of bullish names, we did have two new bullish entries this week in paid. We had NDAQ, the NASDAQ, the exchange. NASDAQ's been in a bull trend for a number of months now. Good trading volume using that 10-day moving average as support, entering on Tuesday morning and exiting half the position on Thursday afternoon. We saw about a 0.9% profit in the 2 days in the stock. Not a huge profit in the stock, still a very grind higher mode. The call options generated about 3.7% profit in those 2 days. Not a huge return, but still positive. Now, we do keep half the position when we have a positive week such as last, so this other half will be exited on Monday, looking at NDAQ to hopefully continue that bullish trend after closing at all-time highs on Friday. The other entry we had was StarBucks. Now, StarBucks is a bit unique in that it is a lower price stock, not making new highs, but it has been resuming an upward trend, finding a ceiling, and it continued this week at the 200-day moving average. Now, the benefit of the paid system entering on Tuesday morning allowed us to get in at a very good entry point, around unchanged for the day on Tuesday before this price escalation occurred Tuesday throughout the trading day. Wednesday and Thursday, a bit of consolidation after a very big day on Tuesday with multiple standard deviation move. And the stock was up 3% in those 2.5 trading days, with the call options up about 23.5%. So you can see that leverage from the call options, the point of trying to find some of these signals. When we see a good potential profit in a stock like StarBucks, we can get multiple returns in the options market. Now, we again exited half the position, looking for half that position to be held through Monday for a final exit Monday near the close. And ideally, StarBucks continues to push through, and maybe if it gets above that 200-day moving average, we see technical buying as algorithms start to buy on that new long-term bullish trend indicator. If not, no major worries because we do have 3 new trade ideas coming this week. They're not in StarBucks or NDAQ, brand new ideas. Those will be out in your inbox on Tuesday morning, so please be aware of that and keep an eye out for them. Hopefully, we're looking at some more really nice positive trades and continuing this bullish momentum. And as always, don't forget about the live trading room. If you want to talk through some of the paid ideas, any other ideas about stocks that you're evaluating, or want some new, fresh ideas, Vlad and I utilize the AI combined with the technical signals, combined with options analytics to find really good, interesting leveraged ideas, bull side as well as bear, including some more complex option strategies such as call verticals. And again, we'll be getting into some of those earnings ideas that are always very exciting coming up next week. This upcoming week, maybe not anything on the earnings side, but the following week, make sure you're on for that because we do have some interesting ideas using complex strategies for how to leverage potential returns and potential trade target price points in those financials and other earnings that are coming up imminently. So we're on from 9:15 till 10:15, 10:30 Eastern for the morning bell, from 3 to 4 for the closing bell. Always open to any feedback, any questions about technical market evaluation, AI, how it's incorporated into trading systems, individual names, and the options analytics, of course. So please please join us there, and we look forward to seeing you in the coming week. As always, if you have questions outside of that, you can always email us. I'm Keith at yellowtunnel.com and Vlad is Vlad at yellowtunnel.com. Thanks again, everybody, for being a valued member of Paid, and I look forward to another profitable week of trading.